Bill Bengen, the godfather of safe withdrawal rates, if I can call you that. Total pleasure to have you here on the Informed Decisions podcast. How are you keeping?
Oh, very good. Thanks for the invitation. I really appreciate it.
No, as I was mentioning to you a few moments ago, I was looking at blog 83 that I did in 2018, which is one of our early blogs. I was talking about your work and the 4% rule as it was at the time.
Yes.
For our listeners that may have missed that or may not have heard a little about your background and the 4% rule, you were a practicing financial advisor and you did some research and it just seems to have exploded. Is that a fair summary?
It is. I never expected that it would attain a level of public interest it has today.
Why do you think it has?
Well, I think it's a vital topic for retirees, to know what they can spend without running out of money is probably their number one concern. So it kind of strikes a nerve in the retirement community.
And so you come up with the safe withdrawal rate and really put it out there, and it hit the world ultimately in 1994, I understand.
That's right. Yes. I wrote a paper at that time, and that's where the 4% rule came out. Even though the number I had in the paper was 4.15%, it got truncated to 4. And then it became a rule, which I hadn't proposed at all because it's really a worst case scenario. It's not something I would recommend at the outset to anyone in retirement. You generally want to see if you get higher rates, withdrawal rates than that. But that applied to this very one unlucky individual retired in October of 1968, and they ran into a buzzsaw of multiple bear markets followed by very high inflation, which had forced them to increase their withdrawals. It was a devastating period for investors, particularly retirees.
So that was the historic periods, 30-year periods that you researched based on certain portfolio that we can get into. The single worst 30-year period, the safe withdrawal rate there was 4% or 4.15%, correct? Is that ultimately
That's
what
right.
we're saying?
And today I've updated it to 4.7%.
So you're being more generous, Bill. You're being more generous, and we'll get into the research as to why. I thought you might be interested to know a little fact that your research, the 4% rule, came out in 1994. In the year 2000, the Irish government brought in a thing called, and you've similar in the US, the distributions, but ultimately imputed distribution, where you have to draw a certain amount from your pension pots if they've been crystallized from age 60. And the figure that they brought in was 4%.
Interesting.
All right. And I have often wondered, did they just pull that from Bill's piece, or where did they get that number? I would be inclined to think the former.
It could be. I don't want to lay claims to looking into the minds of anyone else, but it certainly is a coincidence.
What if you were to put a stab at it? I know you're a very modest man, but if you were to put a stab at it, how many retirees and individuals in America are guided and informed and have been guided and their decisions have been informed by the 4% rule?
Yeah, it's once again a 4% rule in its original form. Is much too conservative. Over the last 100 years, in fact, the average retiree has been able to take 7%, slightly more than that. Haven't been much opportunities for that in the last 25 years because of the nature of markets we're in. But 4.7% is pretty meager, and I hope most retirees would do better.
Okay, interesting. Okay, so and just to frame and I've spoken about this quite a bit on the podcast and in the blog over the years, your hypothesis and your research suggested, and as you said, it's been updated to 4.7 now. So let's work on the new number. If you were retiring in year one today, what's the income, the lowest safe withdrawal rate income that you can take in year one, Bill? Can you talk us through the mechanics of it?
Okay. Yeah, based on the particular investments I use in my model portfolio, today I'd be recommending somewhere in the range of 5.25% to 5.5%. which is still well below the historical average of 7%. And the reason is, certainly in the United States, stock markets are very, very richly valued. And the more highly valued your stock market is, the closer you probably are to a major bear market. And a major bear market early in retirement can have a devastating effect on portfolios. That's why the withdrawal rate is so much lower than the average.
Okay. So if somebody is retiring today, you're saying they could or should be aiming for 5.5% withdrawal rate.
Yeah, in this environment, yes. And that could change,
Okay.
you know, markets change. If stocks suddenly had a big bear market and became cheap, it would probably be quite a bit higher.
Okay. So just because I think the context is important here for Irish people, unless they dictate otherwise from their pension schemes or their retired pension assets, they will be sent 4% or 5% of the scheme value at any given time. Your hypothesis is very different, right? You're saying if you're retiring with a €1 million pension pot today, to use that figure, you're taking in year one, if we use 5%, you're taking 50,000 year one. In year two, that 50,000 is increased in line with inflation. It's not fluctuating based on the pot value in year two. Is that correct?
That's exactly correct. And that's something most people don't understand, but that's how it works. It much works like the American Social Security system, which gives you an inflation adjustment each year.
There you go. And that's what people want, right? People, retirees, which I know from listening to and reading you are one, right? You want steady, reliable, consistent, knowable income.
I believe so. And fortunately, the markets we have allow us to obtain those kind of numbers. We're fortunate to have the ability to invest in stocks and bonds and funds and so forth to produce the kind of returns necessary to support a withdrawal like that.
Okay. Awesome. Okay. Your update. So the original 4% rule is changed to 4.7%. Can you talk to us about what has changed in terms of your thinking and your research around the portfolio? So
Absolutely.
the portfolio debt to deploy for optimal long-term sustainable.
Absolutely. My original research back in 94 was based upon just using two asset classes, which is hardly a diversified portfolio. So over time, as I've gone through multiple research cycles, I've increased the number of assets classes in the portfolio. Today I use 7, 4 of which are U.S. stocks, and one is international stock fund, and the rest in bonds and cash. Important thing to recognize is that probably we haven't topped out yet. If I were to further expand and diversify the portfolio, I think 5% rather than 4.7% would probably be the more attainable number. But I haven't run the numbers on that yet, so I hate announcing something before I've discovered it.
Well, that'll be the next book, perhaps, right? And I believe Congratulations is in Order. A Richer Retirement was published. It was officially launched yesterday. Is that
right?
Correct, Bill?
That's correct. Although many people probably have already received their books because the booksellers got copies early and then sent them out.
Brilliant. So A Richer Retirement by Bill Bengen. So in that you share these portfolios and the research and the rationale behind all of this. So you're mentioning 7 asset classes, potentially further diversification. So I'm delighted to hear international stocks have made the cut there, Bill. What other diversification do you think would be on the radar to help increase the minimum withdrawal rate?
Sure. Some form of real estate investment, maybe real estate investment trusts, precious metals, commodities. There's a whole class of alternative investments can be looked into. Emerging markets, stocks and bonds. A lot of these, including deep value, particularly in the U.S. market, have tremendous potential returns because they're so depressed in value because all the money's been flowing into the large cap AI stocks, and they've been kind of neglected. Market history says that won't last forever.
For sure. In terms of the portfolio, your original research, the 4% rule, was based, I understand it, on a 50% US equity, 50% US bond portfolio, correct?
That's right. Although you could have change that anywhere in terms of the stock allocation from about 40% up to 70%, and you would end up with the same 4% withdrawal rate. It's very interesting, the dynamics of how that works.
And what was your finding on that? So when you increased the equity, did it, in some people's eyes, it would increase the risk, but it probably didn't reduce the minimum safe withdrawal rate? Or what was your finding?
Yeah, as you go upwards from 50% out equity to go to 55, 60, your withdrawal rate stays the same, but then after about 70%, it starts to drop off. And what happens is that if you have a major bear market in retirement, it'll hit you pretty good when you have a very large allocation of stocks. On the other end of the scale, where you have low exposure to equities, the bonds dominate your portfolio, and bonds just don't generate the kinds of returns necessary. They're not comparable to stocks. So there's a sweet spot in between.
And it reminds me of some very interesting research I saw. Again, like a lot of this research, Bill, comes from the US, and it was an assessment of the long-term sustainable income and the risk of ruin of a portfolio based on its, whether it was heavily equity or heavily bond, heavily US with international equity, and ultimately their finding was the risk of ruin, i.e., running out of retirement pot, reduced the more equity allocation you had and the more globally diversified equity that was in the portfolio. But at the same time, it's not going to drive your safe withdrawal rate to 10+%, I would assume.
No, but I think my current model with maybe 11% of international stocks is light on the international stock category. I think if I was setting up a portfolio today, I'd probably have at least twice that much, if not more, in the portfolio, because that's much better values available internationally than are in the United States.
Absolutely. And I was looking at the price earnings ratios, the S&P at approximately 27, MSCI 23, emerging markets 14.
Yeah, that's wonderful. 14 is magical.
It's some value, isn't it?
Well, the U.S. stock market in March of 2009 bottomed out at 14 times on the Shiller ratio, and look what's happened since then. It's gone up, 9 times?
Yeah.
So it's unbelievable in 15 years what can happen.
Yeah, absolutely.
In fact, it's gone too far. But that's either here or there.
That's secondary to what we're talking about, absolutely. And in terms of the safe withdrawal rate, right? So the safe withdrawal rate, if we can say for round numbers, is up towards 5% or 4.7 odd, right? So for people that are listening to this, if they're in the situation where they are spending, so they're drawing down on their pension pots and they're living on that income, and if they're drawing 4%, which is kind of the conventional wisdom here, under certain ages, should they be considering, or what are the things they should consider if they're looking at that and they're listening to this and they're saying, well, we could get an extra 1% of the pot, which could be 10 grand, 20 grand extra a year gross to use and to live and to enjoy now. What are the things you would encourage them to consider or factor in, Bill, before doing such a thing?
Sure. If they're just taking a 4%, actually 4%, I would definitely suggest they go immediately up to 5.25% at least. And that gives a 30% increase in withdrawal. That's pretty substantial. Well worthwhile. And once again, 5.25% I think is a relatively low risk number for this environment. I guess we could go through the 1970s again sometime in the near future. I hope we don't, but it just doesn't seem likely. But who knows?
Okay. And in that scenario, as you said, based on where things stand, 5.25 might be there. Is that with a view to, but hey, if we hit, another bear market, for argument's sake, or worse, a global recession, that you would take that back down, or would you keep it at that, but maybe not increase it for inflation? Or what are the dynamics of that work if people are thinking of ratcheting up?
The 5.25% is kind of like I see this commercial for a tomato sauce with all these ingredients. And they say it's in there, it's in there. It's built into the projection. The 5.2% includes the prospect of a significant bear market early in retirement, which is why it's so low to begin with, not 7%. So there's no need for adjustment. Unless you're in into something like the 1929-32 bear market would drop 90%, then you might have to consider it. But we'd probably be back in deflation again there, and that's what rescued that period of time.
Yeah, for sure. And in terms of, okay, let's say we ratchet up, there's a million euro pension pot. Let's take 52,000 a year gross income. Year one, year two, let's say inflation continues at its 2% kind of trajectory that we're at here in Ireland. I know it's slightly higher in the US, but not a lot.
Yeah.
2 to 3%. If it continues on that, is it a simple case of increase your 52,500 by 3% next year?
That's exactly right.
And in the scenario where we're back to 10% inflation rates, again, is that baked into the recipe?
No, it's not. That would be a return to the 70s kind of a scenario. And then we might be looking at something in the fours once again, rather than a five handle.
Okay. From a practical implementation of this, and we use guardrails for quite a few of our clients that are looking to drive income, but also keep an eye on legacy, etc. In terms of the practical application of this, is there a tool or calculator, or is it, sitting down with pen and paper for yourself, maybe, Bill, or indeed for advisors that you have worked with over the years? What's the practical application of this?
Yeah, I've set out a process in my book. Unfortunately, it's not embedded in software yet. I'd like to be able to get that somewhere, although it'll be kind of complex and expensive to create. But for the most part, I think the tools that are available, and I put some on my website to help people develop their own withdrawal plan, I think it's doable without any major software use.
Okay. And is it an annual decision, an annual review of income strategy and rate withdrawal?
Yeah, I wouldn't do it any sooner than that. Probably 2 years is probably as good a period as 1 year.
Hey.
Unless obviously something happens, the inflation pops up, then you react immediately.
Okay, so if something, a bit of an outlier pops up, then revisit it a bit more frequently, right?
Yes, absolutely.
Okay. I want to pop back to the portfolio for a minute, and you mentioned bonds, right? And a few other aspects that I'd love to get your thoughts on. The bonds, right? Bonds for so long did a fairly reliable job. And then a couple of years ago, 2022, I think it is now at this stage, it's amazing the time flying.
Correct.
They gave a lot of us a bit of a surprise in terms of their correlation and underperformance and negative year. How do you see their role going forward, Bill, within a portfolio where they're trying to do a foundational job ultimately?
Yeah, if you recall, at one point, 4 or 5 years ago, interest rates were much lower than they are today. Bonds were paying close to zero, less than 1%. Even long-term bonds were, 2%. And that's a pretty meager return, and really gave rise to an argument: should we even have bonds in our portfolio at all, or should we put it all into stocks? Of course, you're increasing the risk of your portfolio when you do that. Today's situation, I think, is much more favorable for bonds, because bonds, let's say the 5-year U.S. Treasury yield is about 4.5%. That's decent compared to what it was, 0.5%, 5 years ago. And it creates an opportunity that if the stock market declines, the yields can come down, and that'll make the prices of the bonds go up to help offset some of the losses you might have in stocks. So I think we're back to pretty close to a normal situation now.
Okay. And indeed it was, if I can say, looking at for the silver cloud, or the silver lining on the cloud, even, April this year, where there was a very, very steep decline in equities, bonds, at least global portfolio bonds held their nerve and held firm. So if people did want to get lump sums, for argument's sake, they served that purpose, right?
That's correct. Yeah, and of course, we just hope that something unfortunate doesn't happen in to bonds as a result of, let's say, the deficit spending that a lot of nations are engaging in, and that might cause a negative reaction to the bond market, actually cause prices to fall.
Yeah.
And that would be unhappy, but it's it's a possibility now we can't ignore.
It is absolutely a possibility, and I think it's something that people would have concern around, particularly those that maybe have a that 60-40 kind of approach. If you have 40% of your portfolio potentially exposed to potential very negative outcome, it's a considerable portion, right?
Sure it is, yeah. It would have really an impact on your returns and your withdrawal rate. What I guess there was there was no alternative back then when bonds were yielding practically zero. Stocks looked like the only game in town, but we know stocks are volatile,
Tina, I like it. There is no alternative. Excellent. Is that a reference to Tina Turner now or anything, or no? Just an acronym.
Just a term that I've seen in use. Yeah,
Love it.
Not my creation.
Okay, you can't claim that one, Bill.
No, I don't.
Okay, you mentioned alternatives, right? And I'm seeing an awful lot of private market, private equity. It seems to be around every corner, figuratively speaking, here in my research and in my work in financial planning space. Is that something you are keeping an eye on? You see it as a potential opportunity? Is it something that you would consider in your portfolios going forward, or do you see it as, no, look, this is another one of these in vogue themes?
I don't include any currently in my personal portfolio, but I read the literature on it. I have an understanding what's involved there. The problem, I think, is valuation in the private equity sphere has gotten pretty high. So you may be buying into overvalued assets now that may not generate the returns you hope.
Absolutely. And liquidity then as well, right? Potentially,
Sure.
particularly if we're talking about drawing income, right?
Yeah, that's right.
That would need to be factored in, I suppose.
Yeah, well, I guess if you invest in the form of some kind of a fund which invests in those, you might have better liquidity. But
yeah, absolutely.
It's an area that's interesting, but to me, not particularly compelling at this entry point.
Okay. Yeah. Given the safe withdrawal rate, as you see it, has increased and is higher than, say, somebody that was planning for retirement 10 years ago, and they were saying, I'm going to retire in 2025. So they were aiming for a pot of, again, just to pick a figure, €1 million. Okay. Based on them then having a withdrawal rate post retirement in 2025 of starting at 4%. If the safe withdrawal rate has increased and will stay up, are we potentially retiring too later than we should? Are we saving too much, I suppose?
Yeah, I guess there's multiple ways to look at it, or else not spending enough.
Yes.
That's one of the problems retirees have, is they just don't spend enough. A lot of folks are so fearful that they only want to draw the dividends and the interest and don't want to touch the principal.
Yeah.
And that's contrary to the philosophy that underlies my research, which is a total return approach, which says you take the money wherever it comes from. You don't mind. If it's from growth, that's great. There still should be enough left in your portfolio to allow it to handle future withdrawal.
So in that scenario, if somebody is on track to retire in 2028, they're going to hit their number, say, in 3 years' time, and based on a 4% withdrawal rate, how confident would you be, Bill, to say, well, look, provided you're invested properly for the long term, you could probably go now?
I guess it would depend upon what the market circumstances look like at that time, because the withdrawal rate is highly sensitive to stock market valuation and to inflation. So you want to look at both of those factors as you get really close to retirement, and that's where you could determine what your withdrawal rate should be.
Okay. So if we take this point in time, early August 2025, inflation is under control, if it were, valuations are on the high side, historically speaking. What would be your broad sense around what that would suggest for your withdrawal rate if you were going to start pulling the trigger now?
Applies to a tax-deferred account that you want to last 30 years. 5.25%, the number I think to me seems reasonable.
Okay.
It's a bit above the worst case scenario, 4.7%.
Yeah.
But then again, I don't see worst case conditions in our future unless the
Yes.
wheels come off. No,
Yeah.
it's
Yeah. Yeah.
possible, I guess.
So if can I ask, how confident would you be to be drawing, say, 6% from, if it was your own portfolio and you were 60 today? I know you're a bit you're a bit beyond the 60-year of age mark now, Bill. I've read, but if you were 60 today,
Yeah.
would you personally be aiming for 6%?
No, I think I tend to keep it close to that 5 point something number. 6% would be aggressive in this environment because we're likely to have some kind of stock market adjustment. There's so much speculation and things become so expensive. Those are usually the tinder that, start the fire.
Okay. Excellent. Excellent. I love it. In terms of drawing, if I'm in a situation where I'm drawing 4%, okay, and I, based on listening to you and based on doing my own due diligence, I'm thinking, you know what, I could actually, I'm confident that I could draw 5% or possibly even a little bit more here, but I don't know if I need it. I don't know if I need that income. What's your kind of philosophical view on that? Should you just draw it and spend it and gift it, or keep it in the portfolio for another time? Or what's your general approach to those decisions?
It's an interesting question, really. I don't know how many people are in that fortunate situation where they've accumulated enough assets to generate more income than they need. But, I think it comes down to you spend a lot of years saving, probably generate that wealth. Why not enjoy it while you're alive, rather than leave it to future generations? I mean, you can leave some to future generations, but I think your priority, my opinion, should be yourself and your enjoyment of life. Some
I
of
love
it
it.
that may involve gifting money to your children, just and see them enjoy it while you're still alive.
Love it. And is that something that you try and do yourself?
Yeah, that's it. I'm following a tradition my dad started. And I remember those gifts he used to give at Christmas. Cash gifts were very welcome, particularly when I was younger and struggling. So I've done that with my children too. And it's a nice tradition, I think.
Well
I
done.
do
More
enjoy
power to
them,
you.
know that they're using that money for good purpose.
Absolutely. And I think, to that point, I love working with people where they have the ability and they make the decision to make those gifts to kids or loved ones, whoever, when the recipient actually really values it and needs it, right? As opposed to maybe 10, 20 years down the road when they possibly won't.
Yes,
Wonderful gift.
indeed.
And can I ask again, Bill, without trying to get too personal on it, but I love the non-financial aspects and considerations of retirement. And while you're famed, and that's not too strong a word, you're famed for your research around the generation of income. How have you yourself found the journey of retirement and that next chapter? And obviously, you've kept very busy and very academically challenged and developing. How have you found the journey?
My philosophy of life applies to retirement. Have good friends, have good family, and have passions in your life, interests, hobbies, avocations that you can enjoy and get you going in the morning. If you cultivate those three aspects, family, friends, and passions, you're going to have a great retirement. You're going to have a great life because it covers pretty much everything I consider important in life.
And obviously, a richer retirement and your latest book and research is a passion for you, right? You get a huge kick out of it. Do you see it as a chore, or does it drain you in any way? And maybe doing these conversations is probably not that easy either, right?
It sometimes can be a chore because the calculations involved in some of those
Okay.
charts took me up to 3 weeks to create in the book.
Okay.
But
Wow.
in the end, it's a passion. I'm driven by making progress and getting new results and discovering something new. So it's fun.
Well done. Well done. And as I said, look at it. It will, your research and the impact it has on people is massive. I think there's probably very few people have had such a big impact on the retirement incomes and financial planning of so many in history, I would guess. I don't know. I don't want to sound hyperbolic there, but I think that's probably the case, Ben.
Could be. I'm amazed if that's the case.
One thing I ask all guests on the show, Bill, is for a book recommendation. And obviously I'll be recommending your own book, A Richer Retirement, Supercharging the 4% Rule by Bill Bengen. But any book recommendation that you would, or share a book that really stood out for you, fact or fiction, that would spring to mind that some of our listeners might like to pick up on?
Oh, that's an interesting question. John Bogle, founder of Vanguard Group, wrote a book later in his life called Enough, which I think is short, readable, and very pithy. And that's one thing I would recommend to folks.
Enough. Excellent.
Yeah, that's right.
Enough. Well, speaking of enough, I think you've probably had enough for one conversation, Bill. Where can people find out more about you or pick up the book?
Yeah, go to any online bookseller and look up A Rich Retirement. It'll be available. It's for sale now. And you can also visit my website, bill@bengenfs.com, where I have supplementary information. For example, I have all the charts in the book are in black and white. I've reproduced them on my website in color, which is really important for some of those charts with complex data in them. And I also would include new research, answer questions from folks to the best I can. Although I can't answer specific situation questions, I can ask some general questions about my research.
Brilliant. Well, Bill, again, thank you very, very much indeed for taking the time. I wish you continued success with your research and with the book. And I have got massive value from following and reading your stuff. So thank you very much indeed, sir.
Thank you. I appreciate it.